September 15th, 2007, 11:47 p.m. In the marble lobby of Danske Bank's Estonian branch in Tallinn, a security guard locked the front doors for the night. Upstairs, on the 7th floor, computer servers hummed quietly, processing transactions. In those servers, billions of dollars were moving, not hundreds of millions, billions, every single day. $230 billion would flow through that single branch over the next 8 years. That's more than the entire GDP of Finland, more than Portugal, more than New Zealand, all of it, through one branch office of a Danish bank that most Americans had never heard of. But here's what makes your blood run cold. Nobody noticed, not for 8 years, not the bank's headquarters in Copenhagen, not European regulators, not international watchdogs. $230 billion, much of it from Russian oligarchs, criminal networks, and corrupt officials, washed clean through the global banking system while everyone looked the other way. This wasn't a heist. This wasn't a hack. This was something far more disturbing. This was the financial system working exactly as designed to make dirty money disappear in plain sight. Every year, between 2 and 5% of global GDP gets laundered. That's up to $2 trillion annually. $2 trillion. To put that in perspective, that's enough money to end world hunger 15 times over. Enough to house every homeless person on Earth. Enough to provide clean water to every human being alive. Instead, it vanishes into luxury penthouses in Manhattan, art collections in Geneva, and offshore accounts in the Cayman Islands. The question isn't whether money laundering happens. The question is how something this massive, this systematic, this obvious, how does it happen in full view of the world's most sophisticated financial institutions? Tonight, we're going to follow the money. From the drug cartels of Mexico to the marble floors of Wall Street, from the shell companies of British Virgin Islands to the art galleries of New York. We're going to show you the machinery, the banks, the lawyers, the accountants, the entire infrastructure that makes billions vanish while regulators look the other way. This is the story of the largest legalized criminal enterprise on Earth. This is the story of how billions vanish in plain sight. Let's start with a simple question. What exactly is money laundering? Strip away the jargon, and it's surprisingly straightforward. Someone makes money illegally through drugs, corruption, fraud, human trafficking, arms dealing. That money is toxic. You can't just deposit $10 million in drug money at your local bank and buy a mansion. The government will notice. So you need to clean it. You need to make dirty money look legitimate. The process has 3 stages. First, placement, getting the cash into the financial system. Second, layering, moving it around so many times through so many accounts and companies that its origin becomes impossible to trace. Third, integration, bringing it back into the legitimate economy as apparently legal income. Think of it like this. A Mexican drug cartel earns $100 million selling cocaine in Los Angeles. That cash physically exists. Stacks of $20 bills in duffel bags. They can't just walk into Bank of America with suitcases full of cash. So they smuggle it back across the border to Mexico. They use money exchangers to deposit it into Mexican banks, which have far weaker regulations. Then they wire it to accounts in the United States. Maybe it goes through Panama first, maybe Luxembourg. Maybe it splits into 1,000 smaller transactions. By the time it lands in a Wachovia bank account in Miami, it looks like legitimate business revenue. The cartel can now use that money to buy real estate, fund operations, pay their people. The money is clean. This isn't theoretical. This actually happened. Between 2004 and 2007, Wachovia Bank, one of America's largest financial institutions, laundered $380 billion from Mexican drug cartels. $380 billion. The bank paid a fine of $160 million. That's less than half of 1% of the money they laundered. Nobody went to jail. Wachovia was later acquired by Wells Fargo, which continues to operate today. But cartels aren't the only ones who need to launder money. Corrupt government officials do it. Oligarchs do it. Arms dealers do it. Tax evaders do it. And the infrastructure they all use, the shell companies, the offshore banks, the law firms, the real estate agents, that infrastructure was built and is maintained by the legitimate financial system. Consider BCCI, the Bank of Credit and Commerce International. Founded in 1972 by Pakistani banker Aga Hassan Abedi, BCCI positioned itself as the bank for the developing world. By 1990, it had over 400 branches in 78 countries and more than $20 billion in assets. It was the 7th largest private bank on Earth. But BCCI wasn't just a bank, it was a criminal enterprise. Court documents later revealed that BCCI laundered money for drug traffickers, financed arms deals, bribed government officials, and engaged in systematic fraud. The bank created a labyrinth of shell companies and false accounts to hide its activities. And when regulators finally shut it down in July 1991, $20 billion had vanished. Depositors lost everything. Here's the thing, though. BCCI didn't operate in the shadows. It operated on Wall Street, in the City of London, and Luxembourg. Major auditing firms reviewed its books. Western politicians praised its founder. Bank of America was an early investor. The infrastructure of respectability, lawyers, accountants, consultants, all of them helped BCCI appear legitimate while it looted billions. And it's still happening. In 2012, HSBC, one of the largest banks in the world, admitted to laundering money for Mexican and Colombian drug cartels. $881 million for the Sinaloa cartel alone. The bank paid a $1.9 billion fine. Nobody went to jail. The head of the Department of Justice's criminal division later admitted that HSBC was deemed too big to jail. The fear was that prosecuting the bank's executives would destabilize the global financial system. Read that again. The government decided the bank was too important to hold accountable. This is the ecosystem we're dealing with. An ecosystem where the infrastructure for laundering money isn't hidden in dark alleys or secret bunkers. It's in glass skyscrapers. It's staffed by Ivy League graduates. It's protected by some of the most expensive lawyers on earth. And when it gets caught, it pays a fine and keeps operating. So how did we get here? How did the global financial system become the world's most efficient money laundering machine? To understand that, we need to look at what happened in Estonia in 2007. And in 2007, Danske Bank was Denmark's largest financial institution. Respectable, conservative, the kind of bank your grandmother would trust. That year, Danske acquired Sampo Bank of Finland, and with it, Sampo's Estonian branch in Tallinn. Estonia was in a unique position. A former Soviet republic, it had joined the European Union in 2004. It was building a reputation as a digital pioneer, offering e-residency and advanced banking infrastructure. But it also had something else. It had connections. Connections to Russia. Connections to the former Soviet states. And where there are connections to Russia, there is money that needs to move without scrutiny. The Estonian branch that Danske inherited had about 10,000 customers. Most of them were non-resident customers. Companies registered in places like the British Virgin Islands, Cyprus, or the Seychelles, but controlled by Russians, Azerbaijanis, and other former Soviet nationals. These weren't regular businesses. They were shell companies. Entities that existed only on paper, with no employees, no offices, no actual operations, just bank accounts. And money started flowing, not a trickle. A tsunami. In 2007, the Estonian branch processed transactions worth approximately 15 billion euros. By 2013, that number had grown to over 200 billion euros. In a single year, through one branch, with a few hundred employees. To put that in perspective, that's more money than Denmark's entire GDP. One small branch of a Danish bank was processing transactions equal to the economic output of an entire Scandinavian nation. How was this possible? The answer is simple. Nobody was checking. The Estonian branch operated with a level of autonomy that would be unthinkable in a modern bank. After Danske's acquisition, the branch continued to use its own IT systems, its own software, its own internal controls. Copenhagen headquarters couldn't read the branch's documents because they were in Estonian and Russian. The branch didn't have to comply with Danske's central Know Your Customer procedures. It was essentially operating as an independent entity under Danske's name, and the management knew exactly what they were doing. Investigators would later determine that the Estonian branch deliberately targeted non-resident customers from high-risk countries. They marketed themselves to Russian oligarchs, to Azerbaijani officials, to anyone with large amounts of money and no desire for questions. The pitch was simple. Bring your money here. We'll ask no questions. We'll process your transactions. You'll have access to the European financial system, and nobody will know where the money came from. The mechanics were elegant in their simplicity. A Russian oligarch would set up a shell company in the British Virgin Islands. On paper, that company might claim to be in the import-export business, or consulting or technology. Anything that could justify moving large amounts of money, the company would open an account at Danske's Estonian branch. Money would flow in, maybe from a Russian oil company, maybe from a government contract, maybe from nowhere in particular. Then the company would wire that money to other accounts, other shell companies, other jurisdictions. Maybe some of it would end up buying real estate in London. Maybe some would go to Switzerland. Maybe some would vanish into accounts in Panama. Each transaction looked legitimate on its own. A company in the Virgin Islands wiring money to a company in Cyprus. Nothing unusual there, but multiply that by tens of thousands of transactions, and you've got a full-scale industrial money laundering operation. The brilliant part was that nobody had to lie. The documentation was real, the companies existed, the transactions occurred. It's just that nobody looked at the bigger picture. Nobody asked why a two-person company in the Virgin Islands was processing $50 million a month. Nobody wondered why companies with no visible business were moving hundreds of millions across borders. The system was designed to process transactions, not to question them. And Danske's Estonian branch wasn't alone. During the same period, other banks were doing exactly the same thing. Swedbank's Estonian branch processed over $10 billion in suspicious transactions. Latvia's ABLV Bank was shut down in 2018 for money laundering. Deutsche Bank's mirror trading scheme moved $10 billion out of Russia through simultaneous stock purchases and sales in Moscow and London. This wasn't a few bad actors. This was systemic. Banks across the Baltic states and Europe had discovered that processing dirty Russian money was incredibly profitable. Each transaction generated fees. The more money that flowed through, the more the bank earned. And the risk? Practically zero. Regulators were overwhelmed, understaffed, and operating under outdated rules. The chance of getting caught was minimal. And even if they did get caught, the fines would be a fraction of the profits. By 2015, billions were flowing through this machinery every month. Russian elites were moving their wealth out of Russia and into the West. Corrupt officials were maged at hiding stolen funds. Criminal networks were financing operations. And it was all happening through institutions that advertised themselves as pillars of financial integrity. The machine was running smoothly. Too smoothly. The first warning signs appeared in 2013, but nobody wanted to listen. Howard Wilkinson was a British banker working in Danske's Estonian branch as the head of trading for the Baltic states. He joined the bank in 2012, and almost immediately, something felt wrong. The numbers didn't make sense. The customer profiles didn't add up. Companies with no apparent business were moving staggering amounts of money. Wilkinson started digging. He pulled transaction records. He reviewed customer files. What he found was damning. Thousands of shell companies. Billions in unexplained transfers, connections to Russian organized crime, patterns that screamed money laundering. In December 2013, Wilkinson prepared a detailed report. He documented the suspicious activity. He identified specific high-risk customers. He warned that the Estonian branch was facilitating massive financial crime. He sent the report to Danske's senior management in Copenhagen. The response? Silence. Months passed. Nothing changed. The suspicious transactions continued. Wilkinson escalated. He sent more reports. He raised alarms. He made it clear that what was happening in Estonia wasn't just regulatory non-compliance, it was criminal. In 2010, after repeated attempts to get management to act, Wilkinson watched as the bank did nothing. Frustrated and alarmed, he eventually left Danske, but before leaving, he documented everything. The tragedy is that Wilkinson wasn't the only one who knew. In 2014, Danish authorities were already looking into Danske's Estonian operations. They'd received tips, they'd seen data, but their investigation moved slowly. International banking regulations are complex. Jurisdiction is complicated when money flows across multiple countries. And banks have expensive lawyers who know how to stall investigations. Meanwhile, journalists were starting to notice. In 2015, reporters at the Organized Crime and Corruption Reporting Project were investigating financial flows out of Russia. They were tracking shell companies and suspicious transactions. Some of those transactions ran through Danske's Estonian branch, but the story didn't break. Not yet. The machinery of money laundering has excellent defenses. The transactions were technically legal. The accounts belonged to real companies. The paperwork was in order. Without a whistleblower or leaked documents, proving money laundering is incredibly difficult. The same pattern was playing out at other banks. At HSBC, internal auditors had flagged suspicious transactions involving Mexican casas de cambio, money exchange houses, as early as 2008. The auditors warned that drug money was flowing through HSBC's systems. Management was informed. They chose to continue the relationships. The fees were too lucrative to stop. At Deutsche Bank, compliance officers raised concerns about the mirror trading scheme as early as 2014. The scheme was obvious to anyone who looked. A customer in Russia would buy Russian stocks in rubles. Simultaneously, a related customer in London would sell identical stocks for dollars. The money was moving from Russia to London, and the transaction looked legitimate because it was technically a legal stock trade. Compliance officers flagged it. Nothing changed. This is the pattern. Insiders see the crime. They report it. Management ignores it. Why? Because stopping the money laundering means losing billions in revenue. It means admitting wrongdoing. It means regulatory scrutiny. It's easier to ignore the warnings, pay the compliance officers to stay quiet, and hope nobody on the outside notices. But in 2017, the walls started closing in on Danske Bank. An Estonian television station aired an investigative report about suspicious money flows through Estonian banks. The report mentioned Danske specifically. Danish financial authorities began asking questions. The Danish business press picked up the story. Danske's initial response was denial. The bank claimed it had robust anti-money laundering controls. It insisted that any suspicious activity had been dealt with appropriately. It suggested that the concerns were overblown. But Howard Wilkinson hadn't stayed silent. In early 2018, he went public. He gave interviews, he provided documents, he described in detail what he'd witnessed, the tens of thousands of suspicious accounts, the billions in unexplained transactions, the complete failure of oversight. Wilkinson's testimony was devastating. Here was a former insider, a respected banker, providing detailed evidence of systematic money laundering at one of Europe's most respected banks. The media frenzy began. Danish politicians demanded answers. European regulators launched investigations. In September 2018, Danske released its own internal investigation report. The findings were shocking, even to those who'd been following the story. Between 2007 and 2015, approximately 200 billion euros in suspicious transactions had flowed through the Estonian branch. Much of it originated from Russia and former Soviet states. Oh, that was putting it mildly. The controls hadn't been inadequate. They'd been non-existent. The response across Europe was seismic. If Danske, a large, respected Scandinavian bank, could facilitate 200 billion euros in money laundering, what was happening at other institutions? Regulators began examining other Baltic banks. More scandals emerged. Swedbank admitted to billions in suspicious transactions. ING Bank in the Netherlands was fined for similar failures. The facade was cracking. The machinery that had operated so smoothly for decades was suddenly in the spotlight. And the people in power realized that the entire global financial system had a money laundering problem that was far bigger than anyone wanted to admit. The collapse, when it came, was swift and brutal. In September 2018, Thomas Borgen, the CEO of Danske Bank, resigned. He'd been CEO since 2013, during the height of the money laundering operation. Borgen claimed he hadn't known the full extent of the problem, but investigators weren't buying it. How could the CEO of a major bank not notice that one small branch was processing transactions equal to Denmark's entire GDP? Danske's stock price collapsed. It fell by more than 40% within months. Shareholders lost billions. The bank's market capitalization was cut in half. Investors were fleeing. The reputational damage was catastrophic. But the real reckoning was just beginning. In December 2020, the United States Department of Justice charged Danske Bank with conspiracy to commit bank fraud. Prosecutors had spent 2 years investigating how Russian money had moved through Danske's Estonian branch and then entered the American financial system. The DOJ's case was thorough and damning. They documented exactly how dirty money from Russia had been laundered, layer by layer, transaction by transaction, until it ended up in U.S. banks and was used to purchase American real estate, fund American businesses, and integrate into the American economy. In December 2022, Danske Bank pleaded guilty. The bank agreed to pay $2 billion in penalties to the U.S. government. $2 billion was one of the largest money laundering fines in history. But here's what's remarkable. Even a $2 billion fine was small compared to the scope of the crime. The bank had processed 200 billion euros in suspicious transactions. The fine represented about 1% of that total. 1%. And yet, that $2 billion fine was still more accountability than most banks face. Let's talk about the One Malaysia Development Berhad scandal, 1MDB for short. Between 2009 and 2015, more than $4.5 billion was stolen from a Malaysian government investment fund. The scheme was orchestrated by a Malaysian financier named Joe Low with the assistance of Goldman Sachs bankers and high-ranking Malaysian government officials, including Prime Minister Najib Razak. The money flowed through a network of shell companies, offshore accounts, and major international banks. It was used to purchase luxury real estate in New York and Los Angeles, a super yacht worth $250 million, artwork by Monet and Picasso, and even to finance Hollywood films, including The Wolf of Wall Street. Yes, the movie about financial fraud was partially financed with stolen money. Goldman Sachs underwrote $6.5 billion in bonds for 1MDB, earning nearly $600 million in fees. The bank's own compliance officers raised concerns about the deals, but senior executives pushed them through anyway. In 2020, Goldman Sachs reached a settlement with the Malaysian government, agreeing to pay $3.9 billion. The bank's former Southeast Asia chairman, Tim Leissner, pleaded guilty to money laundering and bribery charges. He was sentenced to forfeit $43.7 million. His colleague, Roger Ng, was convicted in 2022 and sentenced to 10 years in prison. But Joe Low, the mastermind, he's still free. He's believed to be hiding in China, protected from extradition. Despite international arrest warrants from multiple countries, he remains at large. He agreed to forfeit over $100 million in assets in 2024, but he's kept the rest. Somewhere, right now, Joe Low is living off billions in stolen money, and there's nothing anyone can do about it. Najib Razak, Malaysia's former prime minister, wasn't so lucky. In 2020, he was convicted of corruption, money laundering, and criminal breach of trust. He was sentenced to 12 years in prison. In August 2022, he began serving his sentence. He's currently the only high-ranking official from the 1MDB scandal who's actually behind bars. Back to the banks. In 2012, HSBC faced the consequences of laundering money from Mexican and Colombian drug cartels. The bank admitted to moving $881 million for the Sinaloa cartel, the same cartel responsible for thousands of murders, for flooding American cities with drugs, for destabilizing entire regions of Mexico. HSBC paid a $1.9 billion fine. The bank entered into a deferred prosecution agreement, which meant that if they stayed out of trouble for 5 years, the criminal charges would be dropped. In 2017, the charges were dropped. Nobody went to jail. The head of the Justice Department's criminal division, Lanny Brewer, later explained the thinking. Prosecuting HSBC's executives could destabilize the bank's banking license. It could trigger a financial crisis. The bank was too big to fail and therefore too big to jail. Let that sink in. The government decided that a bank and its executives were above the law because prosecuting them might hurt the economy. And this isn't ancient history. In 2017, Deutsche Bank was fined $630 million for the mirror trading scheme that moved $10 billion out of Russia. In 2018, ING Bank paid 875 million euros for facilitating money laundering. In 2018, Swedbank was fined 4 billion Swedish kroner for failing to prevent money laundering through its Estonian branch. The fines keep coming, the banks keep operating, and the money keeps flowing. Because here's the dirty secret. Even with all these scandals, even with billions in fines, money laundering is still profitable. The fines are a cost of doing business. They're budgeted for, planned for, expected. For every scandal that gets exposed, dozens more operate undetected. The machinery keeps running. So what happened after the scandals broke? What changed? The answer is complicated and frankly depressing. Let's start with Danske Bank. After paying the $2 billion fine to the United States, the bank implemented new compliance procedures. They hired hundreds of new compliance officers. They invested in new monitoring systems. They promised transparency and accountability. And to be fair, they probably did improve their controls. But the fundamental problem remains. The same executives who presided over the money laundering operation, or who were promoted during that period, many of them are still at the bank. The institutional culture that allowed billions to flow unchecked hasn't fundamentally changed. In Estonia, prosecutors charged 10 individuals connected to the Danske money laundering scheme. Most were low-level employees or intermediaries. A Russian-Danish woman was sentenced to 9 years in prison. A Lithuanian man got 7 years. But the senior executives at Danske, most of them faced no criminal charges. Thomas Borgen, the former CEO, was charged by Danish prosecutors in 2023, but the charges were later dropped. The message was clear. If you're senior enough, rich enough, well-connected enough, you're untouchable. The same pattern played out with HSBC. After the $1.9 billion fine in 2012, HSBC agreed to a deferred prosecution agreement. The bank promised to reform. They hired a compliance monitor. They implemented new systems. 5 years later, in 2017, the criminal charges were dropped. The bank's executives faced no personal liability. Nobody went to jail. Nobody even lost their job. Compare that to individual criminals. If you're a street-level drug dealer caught with $1,000 worth of cocaine, you go to prison. But if you're a bank executive who facilitated the movement of billions of dollars for drug cartels, you pay a fine and keep your job. The system isn't broken. It's working exactly as designed to protect the powerful. There have been some reforms. After the Danske scandal, European regulators strengthened anti-money laundering rules. The European Banking Authority increased oversight of cross-border transactions. Congress passed legislation requiring more transparency in shell company ownership. The UK introduced new rules for property purchases, requiring disclosure of beneficial owners. These are positive steps, but they're not enough. The fundamental problem is that the global financial system is designed to move money quickly and efficiently across borders, and that same efficiency makes it perfect for money laundering. You can't have a system that processes trillions of dollars in transactions every day and expects every transaction to be thoroughly scrutinized. The volume is too great, the complexity is too high, and the banks have no incentive to look too closely, because doing so would slow down transactions and reduce profits. Consider the actual cost of money laundering to society. It's not just an abstract financial crime. Money laundering finances terrorism. It funds human trafficking. It enables corruption that keeps entire countries impoverished. It allows dictators to loot their nations and hide the proceeds in Western real estate. It facilitates drug trafficking that kills hundreds of thousands of people every year. The United Nations estimates that money laundering accounts for 2 to 5% of global GDP annually. That's between $800 billion and $2 trillion every year. And only 1% of that, 1%, is ever detected and seized by authorities. 99% of laundered money successfully enters the legitimate economy. Think about what that money could do if it stayed in the countries it was stolen from. If the billions that Russian oligarchs laundered through Baltic banks had stayed in Russia, it could have funded schools, hospitals, infrastructure. If the money stolen from 1MDB had been used for its intended purpose, economic development in Malaysia, it could have lifted millions out of poverty. Instead, it bought penthouses in Manhattan and yachts in Monaco. And the banks, they're doing fine. HSBC's market capitalization today is over $100 billion. Deutsche Bank, despite multiple scandals, remains one of Europe's largest banks. Goldman Sachs, even after paying billions in fines related to 1MDB, is thriving. Danske Bank's stock has recovered somewhat since the scandal. These institutions are too big, too interconnected, too essential to the global economy to fail. The people who suffer are the ones without power. The Mexican communities torn apart by cartel violence, funded by money that HSBC laundered. The Malaysian citizens whose government funds were looted while Goldman Sachs looked the other way. The Russian citizens whose national wealth was stolen by oligarchs and hidden through banks in Estonia and Latvia. There have been a few success stories. Malaysia managed to recover some of the stolen 1MDB money, about $4 billion so far. SC Department of Justice's Kleptocracy Asset Recovery Initiative has seized billions in assets connected to money laundering. Some countries have created public registries of beneficial ownership, making it harder to hide behind shell companies. But these are drops in an ocean. The machinery of money laundering is vast, sophisticated, and deeply embedded in the global financial system. For every scheme that gets exposed, countless others operate undetected. The incentives haven't changed. The banks still profit from moving money, no questions asked. The penalties for getting caught are still a fraction of the profits. And the people making the decisions, the executives, the lawyers, the accountants, they face almost no personal risk. Until that changes, nothing really changes. The money will keep flowing, the banks will keep processing it, and every few years there will be another scandal, another investigation, another fine, and then everything will go back to normal. So what do we learn from all this? What does this tell us about the world we live in? First, it tells us that the global financial system isn't just vulnerable to money laundering, it's designed for it. The same features that make modern banking convenient, instant transfers, international reach, minimal friction, also make it perfect for washing dirty money. We've built a machine that moves money around the world at the speed of light, and we're surprised when criminals use it. Second, it reveals the fundamental inequality in how we enforce laws. If you're an individual, if you're poor, if you lack power, the legal system comes down on you hard. But if you're a major financial institution, if you employ thousands of people, if you're connected to politicians and regulators, you can facilitate billions in money laundering and pay a fine that amounts to a rounding error. The phrase, "too big to jail," should terrify us. It means we've created institutions that are above the law. It means that at a certain level of size and importance, accountability simply disappears. And once you establish that precedent, why would any major bank take compliance seriously? They know the worst that can happen is a fine that won't seriously impact their bottom line. Third, these scandals show us the human cost of financial crime. It's easy to think of money laundering as a victimless crime. It's just moving numbers around, right? But those numbers represent real suffering. They represent drugs that killed someone's child. They represent schools that were never built because the money was stolen. They represent communities destroyed by corruption and violence. When HSBC laundered money from Mexican drug cartels, they weren't just moving money. They were enabling an organization that has killed tens of thousands of people, that has terrorized entire regions, that has corrupted governments and destroyed communities. When Goldman Sachs helped loot 1MDB, they weren't just earning fees. They were stealing money that was supposed to develop Malaysia's economy, money that could have improved millions of lives. But perhaps the most important lesson is about complicity. Money laundering at this scale, it doesn't happen by accident. It requires armies of professionals, bankers, lawyers, accountants, real estate agents, art dealers, people with expensive educations working at prestigious firms, people who know exactly what they're doing but choose to do it anyway because the money is too good. There's a tendency to imagine criminals as outsiders, as people operating in the shadows. But the biggest criminals wear suits. They work in glass towers. They have business cards and LinkedIn profiles. They're not breaking into the system. They are the system, and that's what makes this so hard to fix. We're not talking about a few bad actors. We're talking about structural incentives that reward looking the other way. We're talking about a global financial system where following the rules too closely means losing business to competitors who don't. Can this change? Maybe. But it would require something radical. It would require treating financial crimes as seriously as we treat street crimes. It would require prosecuting executives personally, not just fining institutions. It would require international cooperation on a scale we've never achieved. It would require making banks afraid of facilitating money laundering. Right now, banks aren't afraid. They're cautious. They comply with regulations when they have to. They pay fines when they get caught. But they're not afraid. And until they are, the money will keep flowing. Here's the question we need to ask ourselves. If $2 trillion a year can vanish into the global financial system, what else is possible? If banks can facilitate corruption and terrorism and organized crime with minimal consequences, what does that say about our ability to hold power accountable? These aren't just banking scandals. They're symptoms of a deeper problem. We've created a global economic system where profit matters more than people, where the powerful face different rules than everyone else, where vast crimes go unpunished while small ones result in imprisonment. The machinery of money laundering will keep running until we decide to shut it down. And every day we don't, billions more vanish in plain sight. 230 billion euros through one branch of a Danish bank. 4.5 billion stolen from a Malaysian development fund. $881 million laundered for drug cartels by HSBC. These aren't just numbers, they're choices. Choices made by people in positions of power who decided that profit mattered more than accountability. The machinery exists. It's running right now. Somewhere, at this very moment, billions of dollars are moving through the global financial system, from dirty to clean, from criminal to legitimate, and most of it will never be detected. The question is whether we care enough to stop it. If this story opened your eyes to how the system really works, hit that subscribe button, because every week on Corruption Rewind, we're exposing the financial crimes, the corporate scandals, and the political corruption that the powerful don't want you to understand. We follow the money, from Wall Street to offshore tax havens, from corporate boardrooms to government backrooms, so you can see exactly how power protects itself. Next up, we're investigating the offshore empire that helps billionaires and politicians hide trillions. Click the video on your screen right now. You won't believe where the money trail leads. And drop a comment below. Which bank scandal shocked you most? Because the more people who understand how this machinery works, the harder it becomes to keep it running. Follow the money. It always tells the truth.